All right, let's talk about the stock market index. You know, that one single number you always hear about? The one that tells you if everyone's celebrating or, well, freaking out.
Yeah, I mean, you hear it on the news constantly, right? The market is up, the market is down. But what does that even mean? Like, what is the market they're all talking about?
Well, what they're really talking about is a stock index. And the easiest way to think about it is, well, it's like the market's report card, or maybe a thermometer. It's just this incredible tool that lets you check the temperature of the entire market, or even just one part of it, in a split second.
And that's really where its magic lies. I mean, think about it. Instead of trying to keep track of thousands and thousands of different companies, which would be impossible, an index just boils all of that chaos down into one single number you can actually understand. It's the ultimate shortcut.
Okay, so if the index is a report card, how exactly is it graded? What's the formula? Well, here's the thing. Not every company gets an equal say. It all comes down to something called weight. Basically, how much influence each stock has on that final grade.
Yeah, because in the world of an index, not all stocks are created equal. It's kind of like a recipe, right? The amount of each ingredient you put in totally changes the final dish. The weight of each stock in that index recipe is everything. And as you'll see, there are a few different ways to cook this up.
So the most popular recipe by far is called market cap weighted. And it sounds complicated, but it's not. It's just this. The bigger the company's total value, what we call its market capitalization, the more power it has to move the index up or down. Simple as that. Big company, big influence.
Just look at this. It makes it super clear, right? If Megacorp has a great day, the whole index goes up. If it has a bad day, the whole index gets dragged down. Meanwhile, all those little guys, they barely even make a dent. In this kind of index, size is literally everything.
And this isn't just some textbook concept. If you're in India, the big names you hear on the news every single day, the Sensex, the Nifty, they're both built on this exact principle. The biggest, heaviest companies have the loudest voice. Okay, let's switch gears to a totally different recipe. This one is called price-weighted. And honestly, it's a little weird. This method completely ignores how big a company is. All it cares about is the price of a single share. So a stock that costs, say, 600 rupees has way more influence than a stock that costs 100 rupees, even if that 100 rupee company is actually a much, much bigger business overall. Strange, right? And this bar chart just nails the point home. See that? Stock A has the highest price, so it gets the most say. The actual value of the company doesn't matter one bit. It's all about that share price.
Now, you might be thinking, that sounds kind of old-fashioned, and you wouldn't be wrong. But get this. Two of the most famous, most watched indexes on the entire planet, the Dow Jones in America and Japan's Nikkei 225, they still use this exact method.
All right, last one. This is the simplest, most, well, democratic way to do it. Equal weighted. And it is exactly what it sounds like. Every company in the index, big or small, gets the exact same slice of the pie. No special treatment. So here, everything is perfectly balanced. A tiny startup has the same pull as a massive corporation. And because of that, this kind of index can sometimes give you a very, very different picture of what's really happening in the market.
So let's just quickly recap. The recipe really, really matters. You've got market cap, where the giants rule. You've got price weighted, where the most expensive stock calls the shots. And you've got equal weighted, where everyone gets one vote. Each one of them tells a unique story.
Okay, but markets change, right? Companies get bigger, some get smaller, some disappear altogether. An index can't just be frozen in time like a museum exhibit. It has to evolve to stay useful. So how does it do that? Well, there are basically two ways. There's the regular maintenance, little tweaks for things like stock splits. And then there's the big one, the revision. That's where they kick out the companies that aren't cutting it anymore and bring in the new rising stars.
And don't worry, this isn't some random guy in a basement making these decisions. There are specialized professional agencies whose entire job is to manage this. They're like the referees, making sure the index is always a true and fair reflection of the market.
All right, so we've gotten pretty deep into the how and what's of an index, but let's get to the most important part. Why should you care about any of this? This is where it stops being just a number on a screen and starts becoming a really powerful tool for your investments. So for you as an investor, indices are used in a few huge ways. First,
They're the yardstick. They're the benchmark you measure your own portfolio against to see if you're winning or losing. But maybe even more importantly, they're the very foundation for some of the most popular investment products out there today. Index funds and, of course, ETFs, or exchange-traded funds. Let's talk about these for a second because they have completely changed the game for regular investors. These products give you an incredibly simple way to just buy the market. Instead of trying to pick the next winning stock, you can invest in all the top companies at once. So what's an index fund? It's a mutual fund with one super simple goal. Don't try to be a hero and beat the market. Just be the market. It buys every single stock in an index, say the Nifty 50, and just tries to copy its performance perfectly. And an ETF? It's very similar. It's also a basket of stocks that tracks an index. But here's the cool part. You can buy and sell it all day long on the stock exchange, just like you would a single share of a company. So you get the diversity of a fund with the trading flexibility of a stock. It's kind of the best of both worlds. You know, at the end of the day, it all comes back to this one core idea, which our source material puts perfectly. A stock index is an indicator of the performance of the overall market or a particular sector. That's what it is. It's our benchmark, it's our thermometer, it's that report card we've been talking about. And that really leaves us with the big question, the one every investor has to ask themselves. Now that you know exactly how that report card is graded, can your investments beat the index? That right there is the ultimate